Thanks, Elizabeth. And relevant to today's discussion, I've been a very active, for better or worse, investor, both directly in companies and as a limited partner in, I think, 7 venture funds. I've also been in your shoes as an entrepreneur, being involved in a number of spin-outs, including one I'm currently CEO of out of Oregon State University. What I'm not, however, is an attorney, so nothing I say today should be construed as legal advice. And just as an aside, Seattle is very well endowed with extremely experienced and competent securities attorneys, and many of them will offer very attractive packages for getting companies started in the hopes or expectations that there'll be more lucrative transaction opportunities for them in the future. So what I'd like to do today is just initially talk about the variety of financing options that are available to startups, just to position where convertible notes fit in. And I hope I'm not talking at too high level, but I want to talk about some of the specific features and terms that you'd see in a convertible note, and then provide an example. And please feel free to ask questions, although I think we'll have plenty of time at the end. So in looking at the plethora of opportunities for funding, this is clearly the ideal. If you can get customer financing in the form of orders or advance payments, it's non-dilutive and clearly builds your business. But next, founders, friends, family, sometimes people add a fourth, fools. But here's the opportunity to get funding before you're really ready, in that you may have an early concept, but you're still so far from a proof of success that it'll be very difficult to get third-party arm's-length investors. But friends, people who've worked with you before, or hopefully your family has enough confidence in you that it might be the initial source of seed financing. Crowdfunding has become increasingly popular, but is quite problematic. The SEC has provided some means these days for getting small amounts of equity financing, but typically crowdfunding is really more for getting advance payments from interested parties for early versions of your product or service. I think, as you know, angels, individuals, are a great source for seed funding. In this case, it's accredited investors, people with a certain amount of net worth, who are willing to come in early before you're ready for institutional financing. It's a challenge, though, kind of herding cats, as it were, of going to a lot of individuals, and it's very time-consuming. So in looking for angel funding, I think it's often a more productive exercise to look at the angel groups. And there are several in town, probably 6 or 7. Some are very focused on specific areas, be that life sciences, or the one I'm a member of, Element 8, focused on clean tech and material science. But the benefit here for you is that you get a lot of leverage, in that rather than picking up checks $25,000 at a time, you can potentially garner maybe your whole round or a large part of it. Plus, in most cases, you'll get, for better or worse, you'll get some consulting and advisory services. Venture capital funds is pretty much for later stage companies, a little more developed. In this case, whether you like it or not, you will get a lot of advice. I mean, typically they'll mandate having a board seat and will be providing more than money. But the offset for the kind of oversight that you may not enjoy is follow-on funding availability. Typically, angels will put in their money, and the next time they want to hear from you is when you go public, or more likely are sold. But in the case of a venture fund, when they make an initial investment, typically they'll reserve as much as 2 times that for subsequent follow-on funding. Corporate venture arms, this is a form of venture capital, but these are the investment arms of large strategic partners. The positive here for a startup is that they're typically not as valuation sensitive, and they will often, obviously, they have an interest in what you're doing and will help build the business. The downside, however, it may very much limit your options in the future as far as finding other strategic entities to work with, and would also limit your exit through an M&A. Debt, and here I'm talking about traditional debt from financial institutions and banks. This is very rarely available to startups, except if you apply through an SBA guaranteed loan. And keep in mind that taking on debt incurs a personal liability for it, for the founders or principals are personally liable for that in the event of a failure of the company. Revenue loans you may have heard of. It's a relatively new concept. It's not really a loan in that it doesn't constitute true debt. But a revenue loan provides funding, and then the supplier of that revenue loan expects to be paid back as a percentage. You might say almost like a royalty, a percentage of your sales up to a certain amount. So for example, they may loan $500,000 and expect to be paid back 3% of your revenues until such time as they get 3 times their return. It's really only suitable for companies that already have products, and because of that 3 to 5% payment, it's really only suitable for companies that have pretty high gross margins in their model. And then what I want to talk about today is convertible note financing. So a simple definition of convertible note: it's a short-term note, and we'll talk about the specific terms, designed not to stay as a loan, but ultimately to be converted into equity on the subsequent larger, generally VC-led funding round. And the incentive for investors, as we'll discuss, is that they get an interest rate that's to be converted along with the principal, and it's typically done at either a discount to that subsequent round or with some other sweetener in the form of warrant coverage. Some of the advantages for the entrepreneur in pursuing a convertible note as opposed to looking for a price round is that generally this can be closed much more quickly than the often many months negotiation with a VC for a price round. Legal costs are substantially lower, perhaps only 25% of the cost for doing the priced round. And because the terms of the actual equity will be negotiated in the future by the lead investor, you don't need to spend any time negotiating the terms. They will be set in the future. And for an entrepreneur, even if you were in the position, let's say today, to raise a price round, if you can buy some time through the use of a convertible note, presumably you'll get farther along, achieve certain milestones, and the ultimate valuation for your price round will be higher than if you were to go out immediately. As far as the benefit to these participants in a convertible note, in many cases for angels, it's the only time they'd be able to invest, because after the convertible note, the startup company would typically go for larger institutional financing. But specifically, the investor is provided some incentive, as I said, in the form of a discount or warrant coverage to entice them to come in at that early point. But I think it's important to note that a convertible note is often referred to as a bridge note. And this is a critical element, and often startup companies say, oh, they want to do a convertible note because it's easier, but it actually can't be a bridge to nowhere. So the ideal is if it's really a bridge for a short period of time, between 6 and 12 months. Ideally, if you're already in discussion or negotiation with the VC, it's a bridge to get those terms finalized, or at a minimum that you're very confident that with the proceeds from this convertible note, you'll be able to achieve financeable milestones. What you don't want to happen is for the bridge note to mature and you're not in the position to pay it back. So what I want to do now is cover a number of the key terms that you might see in a convertible note. First of all, it is a short-term note, and it states a maturity. It's typically less than 12 months, although I've seen some that are as much as 18 to 24 months. If it's stated a long term, it's not actually that they expect it to be out, but they just don't want to have that pressure of closing early. What I have for each of these terms, by the way, is some of the language you might see. Language can be written in a very flexible way, but in this example, for stating the maturity, it just says, unless converted into a qualified financing, and we'll discuss what that is, the notes will become payable upon demand of the holders of the majority at a certain date, which again would be typically up to but less than a year. One of the incentives, as I mentioned, is that these notes do carry an interest rate. The interest rate is not to be paid in cash, but it aggregates and is paid back in kind when converted. And normally these are not at the rate that you'd see from hard money lenders or bank, but it's enough of an incentive for the company to try to expedite closing the round. And generally speaking, it's in the range of 5 to 10%. Prepayment rights. This I rarely see, but this is this would be essentially a very company-friendly term if it was here, but this would give the company the right to prepay the note before it matures. As an investor, I would never allow that to be in the term because I'm certainly not taking this risk for the 5 to 7% return, but you might see it, and if you can get away with it, go for it. But softening that would be repayment if the majority of holders provide permission, which is the case of the language here. Obviously, you need to state how much you're raising. These are not typically unlimited. Normally has a minimum to close the convertible note and a maximum. And most of the convertible notes that I've seen for tech startups are generally in the area of $250,000 to $1 million as the range. Just as in any either priced round or a convertible note, you want to limit the number of note holders. So rather than enabling 30 individuals putting in $5,000, you typically would see some minimum amount. More often than not, I've seen $25,000 as the minimum per investor. Date of closing, sometimes it's left open-ended, but usually it would state that the initial close will be at a certain date and that they may have additional closings up to a certain date. The obvious interest in coming in early is the interest payment, but a lot of times you'll also see staged sweeteners, where those who come in first in the first closing might get a discount of 30%, let's say, to the price round. Subsequent closing enjoy less of a discount. Important to note, typically the notes are not secured by IP or any particular assets, but as a general obligation. Obviously, they'd be in a first position before founder's equity, but it's typically not collateralized. Now, this is very important. Again, the concept of a convertible note is not to remain as debt, but to be ultimately converted into equity. And so what a conversion trigger does is it specifies the amount that will be required to be raised. That's the most important thing before the note would be converted. And the reason for this, from the investor's perspective, is they want to see that the terms are being negotiated by a serious investor, and that is a credible round. A ridiculous example of the contrary, if you didn't have some conversion trigger, that you might raise $500,000 in convertible note and get someone to put up $100 at a $100 million valuation. So what the conversion trigger essentially does is ensure that at least a minimum amount, it's typically some multiple of the convertible note amount, that would come in that would suggest that it was a rational decision on the valuation and the other terms. So I won't read this, but this would be a typical thing. If you were raising in the convertible note, let's say $750,000, it would mandate that a minimum of $4 million be put in by the lead investor and other syndicate members in order to trigger the conversion. Now, I mentioned sweeteners. So the idea here is that in addition to the interest payment, small as it is, that there's an incentive for investors to participate in this loan. And the two forms that you typically see are either a discount, I think that's more prevalent, where your money will be converted into the Series A or Series B, whatever you're raising, but at a discount, let's say at 25% less per share than the investors in the A or B round themselves are paying. The alternative is to provide warrant coverage. So that would mean that if you put in $100,000, you might get the equivalent of $100,000 convertible or as a warrant with a strike price equivalent to that round itself. And the example here is just one of simply coming in at a 25% discount. Now, it's important to consider the following. What happens if before maturity there is no triggering thing? And often it's not covered in the term sheet or the terms and left to be discussed in the future. But this would be the result of a number of things. One is if, in fact, there is no equity round that's put together by the end of the term. And that might be for a very happy situation. The company may benefit from very strong revenue or some front-end payment or some grant that eliminates the immediate need to raise that money. Secondly, if it has stated a minimum, let's say of a $4 million round, but less comes in, that wouldn't technically be enough to trigger the investment. And the other possibility, and it would normally be under happy circumstances, that if there's an early exit through a sale of company prior to the maturity. So as I said, a lot of times all these possibilities are not covered in the term sheet, but generally speaking, in investments I look at, we try to encourage those contingencies to be covered. So what if it's, what are the possibilities? One is that, in fact, the company has the ability, this is rare, at the maturity date to repay the debt. Or it may state that if no such triggering financing transaction takes place, that your investment is converted into very low priced shares in the company. Again, that's something that the management, the founders, don't want to happen, so it's another enticement to make sure that this converting event takes place. And I haven't seen except recently in many term sheets, but what I also try to do is, let's say there is a positive event of an acquirer comes in with a very attractive price before the maturity of the note. I typically would look to have some incentive for the investors to come in. And what might be typical is, say, in the event of an acquisition, the investors will at least double their money. So it'll come in, it'll convert automatically on a change of control at half the value stated in that acquisition. Again, could either specify a rate of return or a discount to that acquisition value. Again, and I'm happy to send the presentation. I just have some typical language that you might see in a term sheet for each of these terms. I wanted to just go through a little example of what a typical convertible note might look at and what effect it would have on your cap table, your ownership table. So in this case, we're saying this would be a very typical convertible note. We're going to raise a maximum of $1 million. The note matures in 9 months. The qualifying financing would be a $4 million Series A, excluding the convertible note amount, paying 10% interest per annum. And that in the event of a triggering conversion, it would convert at 25% discount. So let's assume, based on that term sheet, $500,000 is raised by note holders. With the $4 million comes in at a stated $2 per share, which, as you see on the cap table, would represent a $10 million pre-money valuation, and it occurs 6 months later. So the note holders have their initial principal of $500,000. the interest earned in kind during that 6 months would be $25,000. So $525,000 would convert into that A round. Remember, the A round itself by the lead investor is priced at $2, but our note holders come in at a 25% discount to that, so at $1.50 per share. So keep in mind, had the note holders not invested in that round but were able to participate in the Series A directly, they would have had to pay the full $2 a share and they wouldn't have the benefit of their interest. And here I just have what the cap table would therefore look like, assuming, as I said, at that valuation, the new investors would come in for $4 million, which would have 54% ownership stake. The $1 million from the note holders would have 4.8% ownership because of the $350,000 share. So again, summarizing what we had said before, the advantage to the note holders' participation is it may have been the only opportunity they had to invest in this company. Secondly, they are able to come in at a discount, and they do earn their small interest. And from the perspective of the entrepreneur, they were able to hold out longer, presumably to create more value in the company before they did their financing, and they didn't have to give up any control until such time as the converting transaction takes place. So that's all I have as far as the formal comments, and I'd be happy to take questions either on convertible notes or other financing.
Well, thank you very much.
Elizabeth, thank you.